Scalping risk. Now, if you are a subscriber to the channel and you've kind of watched some of my videos before, you probably know that risk is a big thing for me. And that's just from experience, guys. I've been smashed left, right, and center by mistakes, new mistakes, old mistakes, as any trader has, regardless of where they are. And when you come down to it, the conclusion is, hey, I just need to be absolutely exemplary with my risk management if I've got any chance of getting to where I want to be as a trader. So, by the way, if you're new here, warm welcome to you. If you haven't watched the videos, that's kind of what I talk about quite a lot is risk. So anyway, the thing we've got to look at really is scalping as its own unique set of risks. It's a unique set of things that could hit the market at any one time, or could hit you at any one time. So let's have a look at them. If you came in from the prior video, you're going to say, hey, that's the first thing you mentioned in the prior video was the last thing you mentioned in the prior video was magnifying emotions. And you're quite right. Number one is magnifying emotions. That really is the risk, because you can be a very good scalper, but if you get emotional in your scalping, you will end up making mistakes that will cost you dearly. You could end up holding on to positions that you really shouldn't be holding on to. You end up taking trades that you really shouldn't be taking. And whilst that swing trading still happens, the effect is a little bit less. Whereas scalping, you can find yourself digging yourself a very big hole if you're in an emotional situation, and that hole can be very, very substantial before you kind of caught yourself and go, well, what have I done? So that's the biggest risk I feel, guys, is that scalping magnifies your emotions. Anyway, apart from that, number two is losses can add up quickly. Because of the frequency of the trading, let's say you're risking £500 per scalp. You have 5 losing trades in a row. You've dropped £2,500. Now, you may be like, well, that's a lot of money. I wanted to only risk, 1,000. So obviously that comes down to planning as well. But the losses can add up quickly because your position size is elevated generally when you're scalping. Your losses can be substantial. You might say, well, actually, I would have preferred to put that £2,500 into a kind of 10-to-1 risk-reward swing trade and see if I can make 20 grand, 25 grand off it. And so you've got to be very mindful of that they do and can add up very, very quickly. And we'll talk about a ton of plan and structure later on. Number three, being stuck in a position. So there's a couple of ways you can look at this. One is being stuck when you're not really, i.e. you're mentally stuck in a position, i.e. you can't seem to pull the trigger to get out of it. You can't seem to execute that stop loss. You can't seem to do what you need to do to cut the cord and get out. Another one is, like I alluded to earlier, a video, probably number three, we talked about the broker, you not being able to get out of the position at all. Been there, done that, had a position size that was pretty hefty, had a good profit on the table and wasn't able to get out. The market was moving aggressively, learnt that lesson myself. I've kind of been in a situation as well where it's worked for me, but you just don't want to, guys. You don't want to be stuck in a position, and that's the hidden risk as a scalper. Again, because the position size is generally elevated, you don't really want to be stuck in it. You don't want to be kind of sitting there thinking, oh man, I'm in this position now, it's killing me, I'm getting hammered. I can't do anything about it. So number one is the emotional side of being stuck in a position, not being able to pull the trigger. Number two is just physically not being able to get out of the trade. Number four, slippage is significant. This is a kind of hidden risk, and it really, because scalping is so fine, you got the line of being a profit or loss, and you're right on that edge line, then you've got to be careful. All the things we're talking about, the commission, and we'll talk about that in a second, but let's talk about it in one may as well. So 4 and 6, we'll go to 5 in a second. Slippage and commissions being significant. So slippage is when you execute a trade and you get a worse fill than you expected. Now in swing trading, it's not so bad. You get a couple of cents slippage, a couple of ticks slippage. Not really so bad and so crucial, because you're looking for kind of $5, $10 on the move, 100 pips, 200 pips, 300 pips on the move if you're trading Forex. But if you're looking for 10 pips and your commission is a couple of pips, if your slippage, is a couple of pips, and you've got a commission or a spread there, then all of a sudden, maybe if you're only looking for a 12 pip scalp and you think, well, that's going to push up to that key level, I don't want it any higher, you get slippage and you've got to pay a bit of spread, all of a sudden you've kind of chopped your profit potential down by 30%. You've got a worse entry because you're higher up in the move, and it really can damage you. So, and also on stops, if you've got stops in, especially scalping, guys, you're trading kind of fast, aggressive markets, candles that are moving strongly in one direction or another, you know, a stop order will trigger an order and put an order into the market when the order is triggered. So you may well, if it's very, very aggressive, someone's sweeping the order book, get a bad price. And that would be the case even if you're using a stop order or a market order when you visually saw that price. So being mindful, guys, that slippage, you know, is significant. It can be significant, and watching out for that hidden risk there. Number 5, on commissions. Let's touch on that now. So commissions and spread. You want to make sure that you have a market that's got very tight spread and low commissions. We'll touch on choosing a market later on, but commissions can add up. And it's not, people think, well, what's the risk in that? The risk is that you end up with a 50 grand commission bill and you've only made 55. You know, yeah, it's a 5 grand profit, but that was not sustainable, because if you've got a slight imperfection in your trading, that 50 grand commission bill, you might only make 40, you've lost 10. So you've got to be aware of that. And commissions or spread, it's the same thing. Different brokers have different ways of trading it. You might have a spread, you've got a bid and offer, you should pay the difference between the two. You might have no spread or very, very tight spread and you pay a commission on top. Regardless, same thing, there's still a cost incurred in trading. And that cost, by the way, if you're trading on a commission basis, you can work that out and say, okay, well, my entry is this, plus my commission would mean that my break even is now this. That's really my entry price if I was trading just on a spread as opposed to a spread plus a commission. So watch out for that. Number 5, just going back on ourselves here, is easy to overtrade. It's super easy to get stuck in an overtrading mentality because you think you're at the front of the screen, you need to be at the screen trading to make money, and it's true. But the trouble is you want to make money, so you're actively trading when there's no opportunity there. You don't want to be trading when there's no opportunity. I know that it's an obvious thing, guys, and we've talked about this before. It's like, yeah, don't trade, there's no opportunity. But for me, it's one of the big things that means people don't get to where they want to go in trading, and why they're out of the game in 2 years or 3 years and not here kind of decade, 20 years plus, because they're trading stuff there's no edge. And that's actually, you know what, that applies for investing. If you're investing to scalping, because if you're trading stuff, you're buying stuff for an investment, it's not really there, but you've just got money burning a hole in your pocket, you're going to get screwed over. The point is with scalping is it's much more likely for you to overtrade, because if you're going through a small, say, get one bad investment out of 20, you might just get away with that. Scalping, you might do kind of 10, 15 trades trying to catch this move that's not really a move and lose them all, and you're like, well, I've just lost 5 grand by trying to catch one move, which is why you've got to be very, very disciplined, and why, you know, the magnifying emotions thing can't be overlooked.